Hi everyone. So we were discussing mock test paper, and in fact, this is video number 2. This is part 2 of that MTP which we were discussing last time. This is series number 1 for our September 2024 intermediate examinations. In case someone has missed the part 1 video, I'll share the link in the description below so that you can easily find that video as well. There we have already discussed MCQs and one total income question that carries 15 marks. So today I'll be discussing with you the remaining questions, and you understand in the descriptive part, we have question number 1 that is compulsory. And from the remaining 3 questions, we have to attempt only 2 questions, right? From question number 2, 3 and 4, we have to do only 2 questions, either 2, 3, 3, 4, whatever it is. So, but for the sake of revision, for the sake of practice, today I'll be discussing all these 3 questions, right? But in an examination, you have to attempt only 2. So let's start with from where we have left last time. So let's come to question number 2A. It says, Miss Geeta, a citizen of India, got married to Mr. Peter of Australia. Okay, she got married in Australia. Okay, and left India for the first time on 20th of August 2023. So this seems to be a residential status question, right? And this point is important for us that she left India for the very first time. That means that she has never been outside India before. So she was always in India before this date. Okay. She has not visited India again during the previous year. So she has not visited again during this year. So in this previous year, she was here for a few months. So we can say that from April, she was here in April, May, June, July, and 20 days of August, right? She has derived the following income for the year ended 31st March 2024. Okay, examiner has given us the details of her income also. What does the examiner exactly wants from us? Let's see. You are required to determine the residential status. See, examiner is asking us first to determine the residential status. We can easily do that of Ms. Geeta and compute the business income and agriculture income of Ms. Geeta for the assessment year 24-25. Very nice. So examiner is asking us first to determine the residential status, and second they are asking us that how much income she is deriving, and that too how much it is from agriculture operations and how much is from business activities. Okay, let us read the income also. Income from sale of centrifuge latex processed from rubber plants grown in Kanyakumari. So here she is deriving income from rubber plants, and that too from India. This agriculture activities is carried out in India. We understand generally agriculture income is exempt, but there are few composite income. Specifically, if you remember that table is very important for us. If assessee derives income from tea or coffee or rubber, so we have a table, we have certain percentages that how much we will consider it as an agriculture activity and how much we will consider it as a business income. Do you remember that table? Let me quickly revise that. Let us revise that table also. So if you remember that, see, if the person is engaged in growing tea in India, growing and selling tea leaves in India, so agriculture and business, how much would be the agriculture, how much would be the business? 60% would be agriculture, 40% is business. If this person is engaged in rubber plantations, then 65% is agriculture, 35% is, you have to learn these percentages, 35% is considered as business. And in case of coffee, see, for coffee there are two things. If the person, the assessee, is engaged only in growing and curing coffee, only in grow and cure, then it is 75% and 25%. Do you remember this? And if this person is engaged in growing also, curing also, grounded and roasted also, then it is 60% and 40%. You have to learn this. This is something which is very important and examiner's favorite question about this. Even they can give you MCQs on this. So this is something which you have to remember. One more thing where students generally makes mistake. What they do is they remember this percentages. If in exams, say there is a question on tea growing business in India, so they remember that there is 60% and 40%. But the thing which they forget is how much is 60%? Is it agriculture or business? So how you should remember it? See, if you remember, if you will see that 60% portion, 65, 75, 60, that is majority portion is coming in agriculture in all these businesses. Majority portion is agriculture and minority is towards business. See, 40, 60, 35 lower portion, 65 towards agriculture. So this way you can easily remember that, because you will remember in for rubber it is 65 or 35, but please don't get confused that 65 is for agriculture or whether it is for business. So whichever is more, that will be towards agriculture, right? So here our assessee is engaged in rubber business. So 65% would be her agriculture income, 35% would be her business income. Got it? Second thing which you should remember, all these businesses should be in India. All these businesses should be in India. If it is from outside India, then it could be 100% taxable. Then it depends upon the residential status. That if the person is a non-resident, then obviously it would be exempt. But if the person is ordinary resident, in that case, their global income is taxable. So if it is from outside India, then it could be 100% taxable. Then we will not apply these percentages. Only agriculture income is exempt. That is from India. If it is from outside India, it is always taxable. Got it? Okay, let's come back. So income from sale of centrified latex processed from rubber plants grown in Kanyakumari means in India. So we know that 65% would be agriculture, 35% would be business income. Income from sale of coffee grown, cured, roasted and grounded in Colombo, that is Sri Lanka. So in that case, this income is from outside India. So you will not apply that percentages. Now, whether this 5 lakh is taxable or not, it depends upon the residential status, right? And also what it is written over here, sale consideration was received in Chennai. Okay, they have mentioned one point over here that although this income is arising outside India, but the consideration is received in India. And we all know that whether the income arises in India or the income, if it is received in India, then it is taxable in case of all the assessee, whether they are resident or they are non-resident also. So anyways, this is going to be taxable. Why? Because sale consideration was received in Chennai. It is in India. Although it is arising outside, but it is getting received here in India. So we are going to tax the entire thing. So you will you say that we will apply that coffee 60%, 40%? No, because that percentage should be applied if it is from India. It is not from India. It is from Colombo, outside India. So you will make it 100% taxable. Why you are making it taxable? Because it is received in Chennai. Even if this assessee is non-resident, then also I'll make it taxable because it is getting received in India. Correct? Because of this particular line. 3.6. Income from sale of tea grown and manufactured in West Bengal, that is in India. So this income is a composite income, and for tea we know that 60% is agriculture, 40% is business income. Income from sapling and seedling grown in nursery at Cochin. Cochin is in India. Basic operations were not carried out by her on land. Okay, first of all, please remember that if the assessee is engaged in nursery business, this is always considered as agriculture activity. 100%. Nursery business is always considered as a agriculture activity, right? The income is fully exempt. Even here the examiner is confusing you that basic operations are not carried out by the assessee, doesn't matter. Whether the basic operations are carried by the assessee or not, nursery income is always agriculture income. So this is 100% agriculture, right? So here it is 65% agriculture, 35% business. Here it is 100% would be taxable, that is business income. 12 lakh would be 60% agriculture, 40% would be business, and this is 100%, it would be agriculture activities. Okay, you are required to determine the residential status first. So first we will determine the residential status. We understand we will apply the basic conditions first. What are the basic conditions? If the assessee is in India during the previous year for 182 days or more, if the assessee satisfies this condition, then the assessee is said to be resident. Let's see for how many days she was here in India. She was here in April, May, June, July, and for some period of August. So in April, she was here in 30 days, May 31, June it is 30, July it is 31, and August she was here for 20 days. The day when she left India will also be considered, right? So 20 days she was there in August, 30, 1, 2, 3, 4, 120, 140. Guys, she was here for 142 days. So during the previous year, she was here for 142 days, and it was the first time that she left India. So she before this date, she was always here in India. So first condition of 182 days is not getting satisfied because her stay of days is just 142 days. But the second condition, we also know that there is a second condition. What is the second condition in that basic condition? It is if the assessee is for 60 days or more during the previous year plus 365 days or more in the preceding 4 years. So she will satisfy this particular condition and she will become resident. Once she is resident, then we have to see whether we will apply those additional conditions, because to determine whether she is ordinary or not ordinary. So we have additional conditions also. So one first additional condition is that during the last 7 years, preceding the previous year, correct? If she was here in India for 730 days or more, 730 days, that is more than 729 days, or you can say 730 days or more. First condition. Second condition is that out of the 10 preceding years, she must be at least resident in 9 preceding previous years. Out of 10, at least for 9, she must be resident. So anyways, in the last 10 years, she was always here in India. She must be resident. So both the additional conditions are also getting satisfied. So that is the reason she will become ordinary resident. So we know ordinary resident she will become, and compute the business income and agriculture income. I think you will be able to do this question. So what I am doing is I would request you to pause the video here, attempt this question, write whatever you think, whatever presentation you are doing, please do it right now and then compare it with my answer. So let's start with this question. Okay, so this is your answer. First, I have determined the residential status of the assessee. I have written here that for how many days she was here in India. Then what are the additional conditions? Both of them are getting satisfied. That is the reason she is resident and ordinary resident. I'll share this PDF also with you. Correct. Second is I have determined that how much income would be agriculture and how much it would be business. So here you can see rubber, for rubber plants it is 65 and 35, 40 that the business is in India, 60, 40. But for coffee business, we will not apply that percentages. Why? Because this income is from outside India. So if it is from outside India, so it depends upon the residential status. It depends whether it is received in India or not. So here, in fact, two things are getting satisfied. First of all, this 100% income is getting received in India. So anyways, it would be taxable. Moreover, the assessee here is a ordinary resident. So we understand for ordinary resident, the global income is taxable. So that is the reason this income is 100% taxable. And for nursery business, as you can see that it is always considered as 100% agriculture, even if the basic operations are not carried by the assessee. The basic operations are not carried by the assessee. Doesn't matter. It is always agriculture income. So here I have written it 100% agriculture income. So the agriculture income comes to 10,17,500 and business income is 10,32,500. Got it? So let's start with the next question. This is question number 2B. It says, briefly discuss the provisions of TDS. Okay, it's a TDS question. Tax reduction at source under the Income Tax Act 1961. So we have to discuss the TDS provisions and determine the amount, if any, of TDS. So if TDS is applicable and TDS should be deducted, so what should be the amount of TDS? We have to tell in respect to the following payments. Okay. So first point says, Mr. Vikas received a sum of 10,20,000 rupees on 28th February 2024. Okay. As a premature withdrawal from Employee Provident Fund scheme before continuous service of 5 years. We understand there is a TDS provision. If you remember the section number, although it is not very important, it's not that important that even if you forget the section number, it's okay. You can write the provisions, right? But yes, there is a section 192A. 192A says, if the assessee is withdrawing from recognized provident fund before the continuous service of 5 years, that we call premature withdrawal. So if the assessee is withdrawing the amount before 5 years, then this income becomes, this amount on maturity becomes taxable and TDS provisions will be applicable. However, there are few exceptions if the amount is getting withdrawn even before 5 years, that is premature withdrawal. But the reasons were some genuine reasons. What are those reasons? If the employee met with some accident, it is due to their ill health, the amount is getting withdrawn. Or in case the business of the employer is getting closed, he's shutting down his operations, then in that case, this amount is exempt. And you understand, if the amount is exempt, then there is no requirement to deduct TDS. Right? So this is the provision. So here it is mentioned that it is a premature withdrawal, okay, on account of termination of the employment due to ill health. So this is covered under exceptions. So if the amount is withdrawn due to ill health of the employee, this amount would be 100% exempt and there is no requirement to deduct TDS. So in this case, you are not going to deduct any TDS. Got it? Okay, so here would be no TDS. You can write down. You can write down. If you remember the section number, please put the section number 192A. If you don't remember the section number, perfectly fine. Just quote the provisions. Just quote the provisions and quote the exceptions also. And this is one of the exception. And therefore, there would be no TDS. Got it? Okay. Second point says, Indian Bank sanctioned and disbursed a loan of 12 crore to B Limited. Okay, they have given a loan to B Limited. For loan, there is no such TDS. On 31st December 2023, B Limited paid a sum of 1,20,000 as a service fees. Okay, this is important. So B Limited is an assessee. They have paid 1,20,000 rupees as a service fees to the Indian bank. So we have to mention whether the TDS would be deducted or not. See, first of all, please understand that service fee is in the nature of interest. Service fee is in the nature of interest. So here the person is B Limited. B Limited is a deductor. They are paying a kind of interest to bank. So whether TDS would be deducted or not, we understand there is a section for interest. In fact, there are two sections for interest. One is section 193, interest on securities. Another is section 194A, interest other than securities. So here, this is section 194A will play a role over here, interest other than securities. So because service fees is in the nature of interest and TDS is applicable on such amount on interest under 194A, right? The rate of TDS is 10%. So should B Limited is entitled, because B Limited is a company, they can deduct TDS. But to whom they are paying, that is also important. To whom they are paying to a banking company, they are paying to Indian Bank, right? Here it is Indian Bank. So whenever you pay to government or to a banking company, then TDS cannot be levied. So here again there would be no TDS implications. So you have to mention that service fees is although in the nature of interest. TDS provisions are there under section 194A. But the reason is the deductee, the receiver is Indian Bank. It's a banking company. So in that case, there would be no TDS implications. Got it? So this was again an important, but in both the cases, there would be no TDS implications. Again, I would request you, please write it down. Whatever you think is correct, please write it down. And then you can compare your answer with my answer. So let's start with question number 2B. So this is the answer. TDS under 192 is levied in case of premature withdrawal of recognized provident fund. But in case there is an exception, if the amount is withdrawn because of ill health, then such amount is exempt. And if it is exempt, then there will be no TDS provisions. So the amount of TDS which should be deducted is zero. It would be nil, right? Second is service fees is the nature of interest. However, this is being paid to a banking company. So in this case, if the amount is paid to government or to a banking company, then there would be no TDS implications. So in this case also, we are not going to apply TDS provisions. The amount would be nil in this case. Got it? Okay. So let's come to the next question. Question number 3. In fact, 3A. It says, Mr. Jain and his wife, Mrs. Jain, okay, are partners in a partnership firm holding 25% share each. So share means share of profit. So they are partners of a partnership firm and both of them have 25% each. It means that both are substantial owner, right? We understand 20% or more, you become substantial owner and both of them are substantial owner. During the financial year 23-24, the firm paid 2,50,000 to each of them as remuneration. So Mr. Jain and Mrs. Jain both have received remuneration from their partnership firm 250. First of all, tell me under which head it is taxable. Is it salary head or PGBP? It's of course PGBP. It's not salary. because for salary there must be an employer and employee relationship, and they are not servant. It should, for salary it should be master and servant relationship, and they are not servant, they are owners, they are partners of the partnership firm. So we understand it is covered under section 28 charging section of PGBP, that whenever the remuneration is received, it could be in the form of salary, bonus, commission, interest on capital. When when it is received from the partnership firm and the receiver is partners, then it is taxable under PGBP. So it would be PGBP income. Apart from this, they provide you the following information in respect of financial year 23-24. Okay. So apart from this income, they have some other income also. Salary received by Mr. Jain from his employer. So he's working somewhere else also, but here he's working as an employee. So this income could be salary income. This income would be salary income because, and whose income it would be? Mr. Jain's income, right? So it is husband's income. And in salary, you will make 1250 is the gross salary, and you can give 50,000 deduction, and it will be 12 lakh rupees. Second point says interest on FD earned by Mrs. Jain. Okay, thus wife is earning interest on FD, IFOS income. How much? 14 lakh rupees. He was earning 12 lakh, and the spouse is earning, wife is earning 14 lakh. The fixed deposit was opened by using her Stridhan. Stridhan means it was her own money. It was her own money. So this amount will not be clubbed because this was her, Mrs. Jain's own money. Its own Stridhan. So 14 lakh is IFOS income. So other income, he has 12 lakh and she has 14 lakh. She is earning more. Okay. Income of their 3 minor children, Neeta, Meeta and Sita, was 15,000, 10,000 and 2,000 respectively. So we understand these are minor children income, and nothing is mentioned about that, whether it's been earned because of their manual labor or whether it is earned by using their skills or knowledge. So nothing is mentioned. So this income will be clubbed in the hands of either of the parent who has more income. Correct? You are required to compute the GTI of Mr. and Mrs. Jain as per the provisions of Income Tax Act for this year, assuming that they have shifted out of the default tax regime. So they are not using 115 BAC, they are using optional tax scheme. They have opted out from default tax regime. Okay. First of all, tell me, how does it matter over here? If they have opted out from default tax regime, what change will take place in this question regarding the clubbing amount of minor children? Because we understand if the assessee is following default scheme, if the assessee follows default scheme 115 BAC, then that 1500 exemption from per child income is not available in default tax regime. It is available only under optional tax regime if they opt out from default. So here, whenever this children income would be clubbed, you can give 1500 exemption from each particular child because they are following optional tax regime, right? So this point is important for this particular clubbing of minor child income. Okay. Second thing is that Mr. Jain and Mrs. Jain is both are having substantial interest and both of them are getting remuneration. Well, this income will also be clubbed. So it depends if they are getting remuneration without any qualification, without any experience, without any skills. I believe that examiner has forgot to mention this, but we will assume that they both are getting without any experience, without any skills, without any knowledge. So this income will also be clubbed, and in the hands of Mr. Jain or Mrs. Jain. So it depends upon the other income. Whose other income is higher, this amount will also be clubbed in that particular husband or wife's hand. So in this case, I'm so sorry, Mr. Jain is earning 50,000 standard deduction. So he's earning 12 lakh rupees. She's earning 14 lakh rupees. So other income of Mrs. Jain is higher. So this income will also be clubbed in the hands of Mrs. Jain. So how much income would be clubbed? See, it is 2.5 lakh each. So her income will become 14 lakh plus 2.5 lakh her remuneration and 2.5 lakh Mr. Jain's remuneration. So her income will become 14 plus 5, 19 lakh, and Mr. Jain's income would be 12 lakh. And again, this income of minor child will be added in Mrs. Jain's hand because her income is more, right? So 15 minus 15, 15,000 minus 1500, 10,000 minus 1500, 2,000 minus 1500 would be the income of Mrs. Jain, right? So again, I would request you to please attempt this question and then you can cross check with my answer. So this is how you should present your answer. This is answer 3A, computation of GTI for assessment year 24-25. You can make one column for Mr. Jain and other column for Mrs. Jain. So income under the head salary, it is for Mr. Jain 1250 minus standard deduction. So his salary income would be 12 lakh rupees, but there is no such salary for Mrs. Jain. But she was having income from other sources, that is FD interest. Okay. Now they are getting remuneration from their partnership firm, that is PGBP income. So I have written it is PGBP. And since other income of Mrs. Jain is higher, so the remuneration which is getting received would be clubbed in the hands of Mrs. Jain. So her remuneration is 250 and her husband's remuneration is 250. That would be clubbed in the hands of Mrs. Jain. So here I have given an assumption that they are receiving this remuneration without any qualification, skills or experience, right? Minor child income would be clubbed. So Nita, Mita's and Sita's income would be clubbed after giving effect of 1500 exemption. If they would have been following the default tax regime 115 BAC, then we will not give this 1500 exemption. Entire 15,000, 10,000, 2,000 would be taxable in that case. But here 1500 for every child will be the exemption which would be available. So this total comes to 22,500. So the gross total income, because the question was asking from us to calculate the gross total income, correct? So the gross total income comes to 12 lakh for Mr. Jain, and for Mrs. Jain it would be 19 lakh 22,500. Got it? So this is our answer for question number 3A. Let's come to the next part, 3B. It says, Mr. Ram, an employee of central government. He's a central government employee. So this is also something which is important for us. So he's a central government employee, is posted at New Delhi. He joined the service on 1st February 2021. So some 2-3 years back, he has joined the service. Details of his income for the previous year 23-24 is as follows. Okay. Basic salary 3,80,000. Is it 380 per month or the total for the year is 380? It is for the complete year. It is 3,80,000 because per month is not written over here. So it is the entire full year salary, 380. DNS allowance is 1,20,000. Okay, for the complete year. 40% forms part of the retirement benefit. So as of now, we don't have to do whatever the percentage which forms part of retirement benefit. As of now, we don't have to do anything. But if there is any point like HRA or rent-free accommodation or any other thing where we require only DA which forms part of retirement benefits, then this particular point would be important for us. Otherwise, as of now, we know that entire DA is taxable. Basic salary is entirely taxable, DA is entirely taxable. So at the back of the mind, we can keep it that 40% of it forms part of retirement benefits. Getting it? Okay. Third point says, both Mr. Ram and government means their employer. Both Mr. Ram and government contributes 20% of the basic salary to the pension scheme referred to in section 80 CCD. Okay, very nice. So they both the employee as well as the employer is contributing to pension scheme. How much they are contributing? 20% of the basic salary. Do you remember this particular section 80 CCD? So we know that we have to give the deductions also of 80 CCD. But before that, please understand that the employer contribution, the central government here, the central government is the employer. The employer contribution will first become the income, will first become the part of gross salary, right? And how much it would be? 20% of basic salary. So 3,80,000 into 20%, it would be 76,000. So first of all, before giving any deduction of 80 CCD and all, first of all, please make it part of the salary. How much it would be? The employer contribution, the government here, the government contribution, right? Not Ram's. His contribution is an investment. It is not income, right? So he must be investing from his salary, from his DNS allowance. This is not the income. The government contribution. So you will write basic salary. He's getting basic salary. He's getting DA as well as the employer contribution. Employer contribution to pension scheme. Whatever it is, please write it first. First, make it part of gross salary. Very important. First, make it the part of gross salary. Then we will see about 80 CCD deduction later on. Also, one more point. If the assessee will follow default tax regime, we understand that we can give only 80 CCD2 in that case. Because in 80 CCD, we have generally 80 CCD1 and 80 CCD1B and 80 CCD2. And both these things, CCD1 and CCD1B is employee contribution, deduction with respect to employee contribution. 80 CCD2 is deduction with respect to employer contribution. Correct? Got it? So if the assessees will follow default regime, then only this particular section is available, 80 CCD2. This will not be available. But if the assessee will opt out from default regime, that is optional regime, then we can give this deduction also, this deduction also. Let's see which scheme the assessee is following. Determine the total income of Mr. Ram for assessment year 24-25. Ignore provisions under section 115 BAC. So the assessee is not opting for default regime. He is opting for optional tax regime. He is opting out from 115 BAC, right? So we can give 80 CCD 1 deduction also, 1B also, and CCD 2 also. Okay. Okay, you can ask me if nothing is mentioned in the question. Please tell me if examiner will give you a certain question and they will not tell you that assessee is following 115 BAC or they are opting out from 115 BAC. So what you will assume, please always assume default regime, because that is by name it is default, right? So always assume that assessee is following default regime if the question is silent about which option they are opting, right? Fourth point. I believe you all are getting this. Fourth point. It says gift received by Ram's minor son, okay, on his birthday from friend is 70,000 rupees. No other gift is received by him during the previous year 23-24. So minor son is receiving gift. This is IFOS income, and this income will be clubbed because this is not by way of any skill or any physical or manual labor or so. So this income will be clubbed in the hands of Mr. Ram, and how much you will be clubbing? 70,000 minus 1,500 or minus 1,500 would not be there. It will be there, because if they would have been following default tax regime, then entire 70,000 rupees would be clubbed. But here they are opting out from default tax regime, so you can subtract 1,500. So 68,500 will become their IFRS income. Okay, let's come to the fifth point. It says on 25th of March 2023, that is our previous year is 23-24, right? And this is before that. They are giving you some information of preceding the previous year. Okay. On 25th of March 23, Ram gifted a sum of 6 lakh. Okay. To Mrs. Ram. So he has gifted 6 lakh to his wife to start a business by introducing such amount as her capital. Okay, she's again, there would be a clubbing provisions because here Ram individual is gifting rupees 6 lakh to the spouse and spouse has invested in their business. So whatever the profit this business will earn, so it will also be clubbed in the hands of the transferor, that is Mr. Ram, but proportionately. It depends that how much is the amount of capital which is invested in the business and how much Mr. Ram has contributed, right? So you have to do a proportionate thing over here. So whatever is the proportion after calculating, please add it in Mr. Ram's hands. And please tell me which head it will be. So we understand that in clubbing, this is important. Please remember this. Whenever you will club the income, it should be of the same nature. It should go in the same head. It depends upon the nature of that income. So if it is house property income, please make under house property. If it is PGBP income, go and club under PGBP. So this is PGBP income. So whenever whatever amount would be clubbed, it would be PGBP income of Mr. Ram, right? Okay. On 1st April 23, that is first day of the previous year, her total investment in business was 10 lakh, which includes 6 lakh gifted by Ram. Okay. So the total capital employed, the opening capital was, because we are concerned with the opening capital, the capital which is on the first day of the previous year. So how much it was? 10 lakh, which includes 6 lakh, which is gifted by Ram. During the previous year, 23-24, she has loss from such business of 1,30,000. Very nice. Is it PGBP income or PGBP loss? It is PGBP loss. How much? 1,30,000 is the loss. She has loss from such business. So if she has loss from this business, so how much will be clubbed? How much will be clubbed? First of all, tell me whether losses can be clubbed. The answer is yes. Because clubbing provision will apply. It doesn't matter whether it is a positive income or a negative income. If clubbing provisions are there, you have to apply it even in case of loss. So here, this is the loss and this loss will also be clubbed, but not entirely 1,30,000. You have to do the proportionate. You have to do a simple mathematics. So this 1,30,000 is the loss. And how much is contributed as on first day of the previous year? How much was invested by Ram? It was 6 lakh. And what was the total capital as in the first day? It was 10 lakh. So 6 by 10, this is the proportion, 60% into 1,30,000, whatever is the amount, that will be clubbed in the hands of Mr. Ram. In fact, it would be a loss and under the head PGBP. Getting it? Okay. So this guy has salary income, this guy has PGBP loss. Okay. First of all, tell me, PGBP loss can be set off from salary? No, it will not be set off from salary. PGBP loss can be set off from any other head except salary. This person has also IFRS income. So PGBP loss can be set off from IFRS income. 6.6. Mr. Ram deposited 70,000 in Sukanya Samriddhi account on 23rd of January 2024. He also contributed 40,000 in approved annuity plan and LIC to claim deduction under 80CCC. Okay. First of all, this person is contributing 70,000 in Sukanya Samriddhi. We understand 80C would be there. So for 80C, he can claim 70,000 deduction. And for 80CCC, it is given 40,000. Do you remember how much is the total limit? For 80C, 80CCC and 80CCD1, we have the maximum limit of 1,50,000 for all these three sections. 80C, CCC and CCD1 should not be more than 1,50,000, right? So 80C it is 70,000, 80CCC it is 40,000, so 1,10,000 is there. And we have to see how much there is 80CCD1. and it should not go above 150. Correct? Okay. Seventh point says he has taken an educational loan, 80E education loan interest from SBI for his major son is pursuing MBA course from Gujarat University. He has paid 15,000 as interest on such loan. So 80E he can claim 15,000. Why I am giving this 80C, 80CCC, 80E and all? Because this person is not following default tax regime. He has opted it out. Okay. It's also a good question. So I would again, I have discussed most of the thing from this question. So again, I would request you to please pause the video, please attempt this question and then compare with my answer. Let's start with this. Okay, done. Okay, let's discuss this also. First of all, write the answer number properly. This is answer 3B. Computation of total income of Mr. Ram for assessment year 24-25. Okay. So first of all, we will calculate the salary income. So he's getting basic salary, fully taxable, DA fully taxable, and also employer contribution to pension scheme. So whatever is the amount contributed by the employer, first make it the income. So 20% of the basic salary, this is 380 into 20%, 76,000. Nothing else in salary. So the gross salary comes to 5,76,000. After standard deduction, it would be 5,26,000. This is salary income. Okay. Then we also discussed that there is a PGBP loss because this income is which is clubbed from his wife's business. So there was a loss in fact of 1,30,000. Amount invested by Mr. Ram was 6 lakh divided by total capital employed as on the first day of the previous year was 10 lakh. So this comes to 78,000 loss. But this loss cannot be set off from salary. It can be set off from IFOS or any other head. But here it would be IFOS. So this person has IFOS income also, which is the gift which is received by the minor child. That would be clubbed 70,000. As the assessee has opted out from default tax regime, so 1,500 would be the exemption which would be available. So IFOS income comes to 68,500. So these are three sources of his income: salary positive, PGBP negative, IFOS positive. First of all, we have to set off this PGBP loss. It cannot be set off from salary, but it can be set off from our IFOS income. But we have 78,000 loss, which is higher amount, but 68,500 lower amount of profit. Let it be whatever the profit which is available. We can set it off. We can set it off. Remaining losses can be carried forward. Remaining losses would be carried forward. So we will set off this particular income from this loss. Remaining would be carried forward. So now we have GTI 5,26,000. Here some people can make a mistake over here. Please don't commit a mistake over here. So some of you can just do a mathematics calculation over here. They will say 526 minus 78 plus 68,500. No, don't make the silly mistake, because this loss can be set off only to the extent of 68,500, right? And whatever is the remaining loss which could not be set off, that would be carried forward. It cannot be set off from salary, correct? So we are left with just salary income, that is 5,26,000. This is GTI. Got it? This was important. Don't make this silly mistake. Second thing. Now deductions under chapter 6A. We have first of all 80C Sukanya 70,000 rupees, 80CCC 40,000 rupees. 80CCD1. Now this is important. I would like to discuss this first. 80CCD1. My recommendation to you is, first of all, do not calculate 80CCD1. First, calculate 80CCD1B. Because this is, actually, you will not make any mistake. By doing this, you will not make any mistake, and it would be, in fact, easier. We understand that 80CCD1B is also employee contribution. And 80CCD1B has its individual limit, maximum 50,000, right? So first of all, calculate how much employee is contributing. How much employee is contributing? Employee is contributing 20% of the basic salary. So basic salary was 380, 20% is 76,000. So employee is contributing 76,000. First of all, take 50,000 out from it and give your 80CCD1B, right? So 80CCD1B, we can take 50,000 from here and we will give deduction of 80CCD1B. So the remaining amount would be 26,000. We will keep it for 80CCD1 now. Simple. So first of all, in your examination, I recommend you, instead of calculating 80CCD1, it's better to calculate 80CCD1B first. So the employee contribution was 76,000. 50,000 we have taken towards 80CCD1B. Now we are left with just 26,000 for 80CCD1. Got it? Now apply your 80CCD1 limit. First of all, 80CCD1 limit, 80CCD1 section shares 1,50,000 with other sections also. Second thing, 80CCD1 has its internal limit also. What it is? 10% of salary. And here salary means basic salary plus DA forming part, 10%, right? So it would be 10% of the salary, basic salary plus DA forming part. DA forming part is 40%. So this would be 380 plus 40% of this into 10% comes to 42,800. And the actual contribution is, although it was 76,000, but we have already taken the advantage of 50. So we are left with 26,000. Whichever is lower, it would be 26,000. Correct? And just check whether we are going beyond 150 or we are within that limit of 150. 70 plus 40, 110 plus 26, 136. We are within the limit of 150. There is no issue now. So 80C is 70, 80CCC is 40, 80CCD1 is 26, 80CCD1B is 50,000. I believe that you will find this one easy. So first of all, before calculating CCD1, I would recommend you calculate CCD1B first. Got it? 80CCD2 is easy. Whatever is the employer contribution was 76,000, right? 20% of basic salary. And we have limit of 80CCD2, we have a limit of 10% of salary, basic salary plus DA forming part. But in case the assessee is a government employee, that 10% would be substituted by 14%. Here we have to take 14%. Here also you can make a mistake. So please remember, the assessee was a central government employee. So we have to give 14% of that salary, basic salary plus DA forming part. So the actual contribution was 76. 14% of salary is 15,920, whichever is lower is 15,920, 59,920. Got it? Okay. Now the last is easy, 80E, that is interest on education loan, 15,000. So our total deduction comes to 26920, 526 minus this amount. This is our total income, 265,080. And please don't forget to write that there is a loss also which could not be carried forward, which could not be set off. That is the reason we are carrying it forward 9,500. I have mentioned this also over here. Got it? So again, this was a good question of salary deductions, clubbing and everything. Let's come to the next question. Although you have to do only 2 questions out of second, third and fourth, you have to do only 2 questions. But for the sake of practice, we are doing all 3. Let's come to question number 4. It says 4A. Determine the capital gain or capital loss, as the case may be, on transfer of listed equity shares. Listed equity shares. I believe that they are referring to either 112A long term or 111A short term, right? So we understand for 112A we have a tax rate of 10%, remember, and also we have to give 1 lakh rupees exemption, and in over and above 1 lakh we will charge 10% as tax. And for 111A we have tax rate of 15%, correct? Recently in this budget it has been changed, but that is not applicable for our September 2024 examinations. Neither for January 2025. It is applicable from June 2025 examinations. Determine the capital gain losses on transfer of listed equity shares. STD paid both at the time of acquisition and transfer of shares. Okay, good. So STD was paid both the times, at the purchase and as well as on the date of transfer. And units of equity oriented mutual funds. Okay, STD paid at the time of transfer. Fine. So we have to determine the capital gain and the tax, if any, payable thereon. So first we have to calculate the capital gain also and the tax also. In the following cases, assuming that these are the only transactions covered under section 112A. 112A, I think now they are referring to long term. So we will apply 10% rate, but it should be over and above 1 lakh, correct? For the previous year 23-24 in respect of these assessees. So we have certain assessee 1 and 2. Okay. Mr. Shagun purchased 300 shares in A Limited on 20th of May 2017. Very good. So it was before 31st January 2018. I'll tell you that. So they have purchased 300. This person, Mr. Shagun, has purchased 300 shares on this particular date at a cost of 400 per share. Okay, the actual cost is 400. He sold all these shares of A Limited on 31st May 23. So during our previous year, this person has sold entire 300 shares. And how much is the selling price? The selling price is 1200 rupees. The price at which these shares were traded in National Stock Exchange on 31st January 18 is as follows. Highest trading price, average trading price, lowest trading price. Okay, so this is the first portion. First of all, understand, this is 112A. We understand it would be a long-term 10% taxable over and above 1 lakh rupees. What is the full value of consideration for one share? Full value of consideration would be 1200. For 300, we'll multiply it by 300. That is not a problem. Minus cost of acquisition. First of all, tell me whether we have to do index cost of acquisition or indexation is not allowed in 112A. Indexation is not allowed, right? So we have to do only cost of acquisition. How much is the cost? The actual cost was 400. So should we take 400 as a cost? No. If these shares were acquired before 31st January 18, so before this date, if they were acquired, so in this case, yes, they were acquired before 31st January 18. If they would have acquired after 31st January 18, then there is no issue. We can take the cost as it is. But if they were acquired before 31st January 18, then we have to take the cost as actual cost or the market value as on 31st January 18. So we have to take the market value over here. The market value. Now the question is which market value? We have highest trading price, We have average trading price, we have lowest trading price. We have to take the highest one. We will give the maximum advantage to the assessee so that he can increase his cost. So we have to take the highest one. Which one? 700. So 400 or 700, whichever is higher. So the cost would be 700. So 1200 minus 700 would be the 500 would be the capital gain on one share into 300 you can do. Also, one more thing, please remember. Whenever you take this fair market value, this is also very important. Whenever you take the fair market value as on 31st January 2018, it should not be more than the selling price. It should not be more than the selling price. So our selling price was 1200. So we are okay to take 700 over here, right? If this would have been, let's say 1300, so we cannot take more than 1200 in that case, right? So here there was no issue. We can take 700 as the cost of acquisition. So I think you will be able to calculate the capital gain over here. So how much would be the capital gain? 500 into 300. I think it would be 1,50,000. You can calculate the capital gain would be 1,50,000. Now tell me, because we have to determine the tax also. So will you apply 10% on the entire 150? No. Please reduce 1 lakh from it, and on 50,000 rupees, you can apply 10% tax plus 4% cess you can add. Okay. We are assuming that this assessee must be having some other heads income also, correct? Okay, second point. Mr. Raj purchased 200 units of equity oriented funds. Again, 112A equity oriented funds. Fund A on 1st February 2017. Again, this person is acquiring before our 31st January 18 date. They are acquiring before this date. So we have to take the actual cost or the fair market value, which is on 31st January 2018, whichever is higher. Same thing. The units were not listed at the time of purchase. So these units were not listed at the time of purchase. Subsequently, units of Fund A were listed on 1st January 18 on National Stock Exchange. Very good point. I'll tell you what it is. Mr. Raj sold all the units on 3rd of April 23. That is during our previous year on April 3rd. He has sold for 900 rupees. So 900 rupees is the selling price. 900 rupees is the selling price. It's a full value of consideration. Okay. The details relating to quoted price on National Stock Exchange and net assets value of the units are given here under highest price, average price, lowest price. You know that you have to take highest price, but also net asset value is also given. Why they have given the net asset value of this unit? Now please understand. See, this date is, you must be knowing that you have to learn this date, 31st January 2018. So first of all, tell me whether these units were listed on this date or not. Whether they were listed on this date or not. Because if they were listed, if the answer is yes, if they were listed, you have to take the trading price. Trading price means that is there on the stock exchange. But if they were not listed, then we have to take the net asset value. We have to take the net asset value, right? So first of all, tell me whether on this date these units were listed. Although this question has mentioned that the units were not listed at the time of purchase. They were not listed on this date when we have purchased. But subsequently they were listed on which date? 1st January 18. On January 18, 1st January 18 they were listed. So we can say that on 31st January 18 they were listed. So they were listed, yes. So we have to take the trading price. And you understand which trading price? Lowest, average, or highest? Highest. So you have to take the highest price over here. Will you be taking the net asset value over here? No, because they were listed. So we will not go on this part. It was listed. So we have to take the highest trading price. So this information for this table, we have 750 rupees. We will take 750 rupees. Okay. So tell me how much is the full value of consideration for one unit? 900. How much is the cost? We know that we don't index in 112A. For 112A, we never index. Okay. So how much is the cost? The actual cost was 550. The actual cost was 550. The fair market value as on 31st January 2018 was 750. Whichever is higher, it is 750. So you have to take 750 as the cost. 150 would be the capital gain on 1 unit, and how much are the units? 200. So it would be 150 into 200. I believe 30,000 would be the capital gain. How much would be the tax? Zero. Why zero? Because in any ways we have to give an exemption of rupees 1 lakh. So it is not exceeding 1 lakh. So there would be no tax on this particular transaction. Correct? One more thing, please remember. Whenever you will take the fair market value as on 31st January 18, please make sure that it should not be more than your selling price. So here the fair market value was 750 and it is not more than my selling price. Selling price was 900, right? So we can take 750. If this would have been 950, then we would have taken just 900 in that case, right? It should not be more than the actual selling price. Okay, so this was again a good question. Okay, so there is a choice in 4A. In fact, there is an internal choice. 4A, you can attempt either this question, long term question, or you can attempt the second one. Okay, let us first discuss, we'll first attempt this question first. I've already discussed. I would request you to pause the video here. Please attempt this question. Then you can cross check with my answer. Then we will go on the second alternative also. Okay, let's start with this. So this is 4A and I have written it first alternative because we have second alternative also. It's an internal choice. So I believe that you will be able to do this. I'll share this document also with you. So the full value of consideration in first case, it was 300 shares into 1200, 3,60,000. Cost of acquisition, actual cost was 400. Fair market value on 31st January 18 was 700 and it should not more than the selling price. So it's okay because the selling price was 1200 and so it is not more than 1200. So we can take 700. 400 or 700, whichever is higher, that would be 700. So my cost would be 300 shares into 700 rupees per share, 2,10,000. Capital gain under 112A, 1,50,000. And on this value, we have to compute the tax on capital gain under section 112A. First of all, we will exempt 1 lakh. And then on 50,000, we will apply our tax rate of 10%. So 10% would be 5,000 plus 4% says 5,200. Got it? And the second was related to units. I believe that you will be able to do it. Correct? So let's come to the second alternative, the second internal choice. It says, Aman has furnished the following particulars relating to payment made and expenditure incurred towards scientific research for the year ended 31st March 2024. Okay, so he has furnished some information regarding the scientific research expenses which the person has made. Payment made to AB University and approved university. Outside research. This is outside research. Payment made to SIA College. Again outside research. Payment made to IIT Bangalore as approved program for scientific research. Outside. These three are outside research. Correct? These three are outside research. And fourth point says machinery purchase for in-house scientific research. This is obviously in-house, 25 lakh. So we understand in section 35, we have two things. If you are if you are incurring capital expenditure for in-house research or revenue expenses for in-house research, 100% deduction is allowed, but it should not be land, right? It should not be land. Other than land, capital expenditure is allowed, revenue expense is allowed, 100%. Okay, for in-house and for outside research also. So for outside research, it depends that assessee is following default tax regime or they are opting out from default tax regime. If the assessee is following default tax regime, then there would be no deduction for outside research. Then outside research provisions is not applicable. Only in-house research is applicable in case the assessee is following default tax regime. I believe that you got this, right? If the assessee is opting out from default tax regime, then you can give deduction for outside research also. Let's see. Compute the deduction available under section 35 for of the Income Tax Act while computing his income under the head PGBP. So we have to compute the deduction which should be available under section 35 under default tax regime 115 BS. So see, they have mentioned that we have to follow default tax regime. It means that outside research deduction will not be available. Only and only in-house research 25 lakh, and this is a machine, then you can give 100% deduction. If this would have been building, 100% is allowed. If this would have been land, then no deduction is available. So the answer would be 25 lakh. This is an easy question, right? If I would have been in your place, I would have opted this. If this question will come in examination, I will not have opt this, I will opt this. This is very easy. Okay. Will you do this? I believe that you can do. Okay, let's do this first and then we will come to the next question. Okay, now the last question for today. 4th B. It says, Mr. Shailesh is a marketing manager in Smile Limited. From the following information, you are required to compute his income chargeable under the head salary for assessment year 24-25. So it's a salary based question. So he's a marketing manager in Spine Limited, not a government employee, in a private company he's working, and we have to compute the salary income. Basic salary 70,000 per month. That is 70,000 if he has not resigned during the year, if he's not left the job. If he's working for the entire year, then 70,000 into 12 would be the basic salary, fully taxable. DNS allowance 40% of basic, fully taxable. Third point, he is provided health insurance scheme approved by IRDA for which 20,000 is incurred by Smile Limited. What it is? It's a perquisite. Health insurance is provided by the employer, and employer is incurring 20,000 rupees on the health insurance. How you will treat this? This is exempt perquisite. So this is exempt perquisite. You will not make it taxable. This is exempt. So this is taxable. This is taxable. This is exempt. You will write in your answer, but you will write exempt over there, or you can write nil or dash, whatever it is. Fourth one, received 10,000 as gift voucher on the occasion of his marriage anniversary from Smile Limited. So the employee has received a gift voucher of rupees 10,000. Now we understand that if you receive gifts from your employer, and if they are cash gift, then they are fully taxable, whether they are more than 5,000 rupees or less than 5,000 rupees. If it is a cash gift, it is a kind of bonus, then it is fully taxable. But if it is a gift in kind and the value of that gift exceeds 5,000 rupees, then it becomes taxable. So here it is gift voucher. So you will assume that it is in kind. So 10,000 will become taxable. Now you have two options over here. There are two alternatives. Institute also gives you two alternatives. See, if it is, first of all, it is gift in kind and it is more than 5,000 rupees. So the first alternative is, if it is more than 5,000 rupees, then make it entire make entire amount taxable. So this is the first alternative, and I would recommend please follow the first alternative. Make the entire amount taxable. So 10,000 would be entirely taxable. Second alternative is also correct. If you would like, you can subtract 5,000 from it and make the remaining taxable. That the alternative is also okay. But please follow the first alternative, because institute also follow that. They also give both the answers, but first they give answer that it will become 100% taxable. So the entire amount will make it taxable. So you can follow either of the two, either 10,000 fully taxable or the remaining in excess of 5,000, you can make it taxable as you wish. I would recommend make it entire taxable. Fifth point. Although I understand it would not be beneficial to the assessee, but for the purpose of answering it in the examination, make it 100% taxable. Fifth point. Smile Limited allotted 800 sweat equity shares. Okay. In August 23, the shares were allotted at rupees 450 per share, and the fair market value on the date of exercising the option by Salesh was 700 per share. Okay. So at the time when the employee has exercised the option, the fair market value was 700. And how much is being recovered from the employee? 450. So he is getting a benefit of rupees 250 per share, right? 250 per share. And how much is the number of share? 800. So 250 into 800, how much it would be? 2 lakh. It will become the perquisite. It is a taxable perquisite. So whatever is the benefit, what is the difference of the value, compare the market value on the date when the assessee is exercised the option minus the amount which is recovered from him. So this is the difference, this is the benefit into number of shares, make it a taxable perquisite. So this was easy. Sixth point. He was provided with furniture during September 2019. Okay. So the employer has given him a furniture for use, that you can use the furniture. And since when? Since December 19. The furniture is used at his residence for personal purpose. Okay. Will you make it perquisite? The answer is yes. So whenever the assessee will give you any asset to use, see, if it is a laptop or computer, if they will give you a laptop or a computer to use, it is a tax-free perquisite. Please don't make it tax-free. They are giving it just for use. They have not given you permanently. If they will give you permanently, then it will become perquisite. But if they are giving you just for using the computer or laptop, actually it is not for, although they are saying that you can take it to your home, but they will call you and ask you that please make this presentation, please do this work, make this Excel file and so on. So for laptop and computer, please make it tax-free perquisite. For motor car, we know we have special provisions for motor car. For other things, for other assets, make it 10%, 10% per annum of the actual cost. So whatever is the actual cost? The actual cost was 1,10,000 rupees into 10%. Into 10% per annum. So it depends for how many months, for how many days they have given it to you. You can calculate it accordingly. So this is for the use of furniture. So the actual cost was 1,10,000. So you will make 1,10,000 into 10%, and it depends upon the number of months. On 31st March 24, the company offered the furniture to him at free of cost. What does this mean? This is last day of the year. This is last day of the year. It means that this person has used, first this person has used the furniture for the entire year. And on the last day, the company is saying that you can keep this furniture with you. On permanent basis, you can keep this furniture with you, right? So it will become the perquisite. First of all, we have to calculate the depreciated value of this furniture. So when it has been given to the assessee on 31st March 2024, so you have to calculate the depreciated value. Once you calculate the depreciated value, you have to find how much amount is being recovered from the employee. So here they are saying that we are not recovering anything, we are giving it free. Okay. So nothing would be subtracted, the entire depreciated value. So generally it is depreciated value minus the amount recovered. Minus the amount recovered from the employee, but here the amount recovered is 0. So whatever is the depreciated value minus 0 will become the perquisite. And how you will be computing the depreciated value? You will apply the depreciation rate which are given in the salary. Please don't apply PGBP depreciation rate. You have to apply the depreciation rate which is there in the chapter of salary for valuing the perquisite. So what is the depreciation rate? So we have three categories over there. If it is computers or laptop which is being given to you permanently, not for temporary use, permanently. So if it is computers or laptop, then the depreciation rate is 40% or 50%. 50%. 40% was PGBP, but for the purpose of calculating perquisite, it is 50%. And by which method you have to do it? By written down value method, reducing balance method. If it is motor car, then 20% written down value method. For computers, it is 50% written down value method. And for other assets, it is 10% straight line method. It is straight line method. So here it is not car, it is not computer, it is other assets. So here you will calculate the depreciated value by applying 10% straight line method. Second thing, this 10% depreciation should only be for completed years, and for any part of the year you have to ignore completely. So you will start it from, we will assume that it was first put to use in September 2019, because no other date is given to us that when it was purchased and first put to use. So we'll assume it was used first time in September 2019. So from September 19 till this date, 31st March 24, you have to calculate the number of days, and part of the year please ignore. You have to compute only completed years. So from September 19, September 21, September 21 to 22, 23. It would be 4 years complete, right? It would be 4 years in some months. So some months we will ignore. It would be only 4 years. So how much would be the depreciated value? 1,10,000 into 10%. It's for 1 year, and it is SLM. We understand depreciation will be same for all the years. So into 4 you can do, that is 40%. So depreciated 44,000 would be the depreciation. So 1,10,000 minus depreciation for 4 years. After that you will get the depreciated value as 66,000. So 66,000 is the worth of this furniture, and how much assessee is paying? 0. So 66,000 would become the perquisite value, right? This is for when the asset has been transferred completely, permanently, right? So this point has, guys, please understand, this point has two particular perquisite. One is use of furniture, and for how many months it has been used this year? Entire for 12 months, because this was gifted to him on the last day. So for entire full year, please calculate use of furniture perquisite, and also calculate sale of furniture, although it has been sold, or you can say gift of furniture, because it's been sold for 0 value to the assessee. So sale of furniture, that is permanent transfer. So please apply both these perquisites. Don't make this mistake that you will apply only sale perquisite or only use of furniture. Please apply both these perquisites. Getting it? Okay. Next point, 7th point says, receive 10,000 towards entertainment allowance. You understand entertainment allowance is fully taxable. Okay. There is a deduction also under section 16 for entertainment allowance, but that is only for government employees, and this person is not government employee. Second thing is that if assessee is following default tax regime, then entertainment allowance deduction and tax on employment deduction is not available. Only standard deduction is available in default tax regime. In optional tax regime, you can take all these three, but for entertainment allowance, first of all, you make it taxable. Make it part of gross salary. Then for if assessee is following optional tax regime, and if they are government, central government, state government employees, then you can give entertainment allowance deduction. Otherwise, here there would be no deduction for entertainment allowance, because assessee is a non-government employee. Correct? Make it just make it taxable. 8th point, housing loan at a rate of 4.5% provided by Smile. It's a typical salary question. They are giving you most of the perquisites. So this is concessional loan, and how much is the rate which is charged by the company? 4.5%. So you have to see the bank rate, the SBI rate, the lending rate for SBI for similar purpose was 8%. So the bank rate is 8%. Employer is charging 4.5% from you. So 3.5% is the interest saved. This is the per user. So 3.5% is the interest saved. Okay. And how much is the amount outstanding? On 1st April 2023. So at the beginning of the year, the amount outstanding of the loan was 15 lakh rupees. 50,000 is paid by Shailesh every quarter towards. They are giving you a typical question of salary. See, if the total amount was 15 lakh for the entire year, then it would have been a simple calculation. 15 lakh was outstanding for the entire year if this would have been the case. So into 3.5%, this would be the per user. That would be a simple calculation. But the point over here is they are changing the outstanding value also, because the assessee is paying in every quarter. Okay. And which is starting from June onwards. So from June onwards, he has started paying. So here you have to do some mathematics over here. So for every month, you have to calculate how much is the outstanding at the end of the month. So in April end, the outstanding was 15 lakh. In May end, the outstanding was 15 lakh. But in June, the assessee has repaid 50,000, and this he will be doing every quarter. So in June end, the outstanding would become 14.5. Correct? It is lakh, 14.5 lakh. And then it will remain for same for next 3 months, for July and August, 14.5. And in September again, because every quarter he's paying 50,000. So in September, it will become 14 lakh. Then in October and November, it will remain 14. And in December, it will become 13.5. And again in January and February, it will remain 13.5. And in March end, it will become 13. So you have to do good mathematics over here. So for every month, on 15 lakh into 3.5%, and that too for 1 month into 1/12. You have to find this per QZ, this, and please make addition of it. And this is the per QZ value. So here there is a bit calculation, but it's not difficult. It's easy, but yes, it's a time-consuming calculation. Last point is facility of laptop costing rupees 50,000. Is it saying that they have given you the laptop permanently, or it's just a facility they have provided you on a temporary basis? So it says it's a facility they have provided you on a temporary basis. So we understand for computers and laptop, the per unit value is nil. So it is not taxable, it is nil over here. Again, a very good question, a typical question of salary. So I would request you to please attempt this question first and then check with my answer. Okay, let's start. Okay, so this is our last answer, answer 4B. You must have seen this. Basic salary, fully taxable, DA fully taxable, health insurance is exempt. Gift voucher, because it is more than 5,000 rupees. So I have made it entire amount taxable, or you can also make in excess of 5,000, you can make it taxable. In that case, your answer would be a bit different. It would be 5,000 rupees less in that case. So it's your wish. I would recommend make entire amount taxable. Certificate shares we have already discussed. 700 minus 450 into 800 shares, 2 lakh. Use of furniture. See, use of furniture, there are two purchases actually. Use of furniture for the entire year, 1,10,000. Actual cost 10% for the entire year. So one is 11,000. Second is they have sold you the furniture, and that too for free, of course. So depreciated value is 1,10,000 minus 10% SLM for 4 completed years. So depreciation will come to 44,000. 110 minus 44,000, 66,000 is the depreciated value. It's the worth of the furniture, and they are giving you for free. So 66,000 would be the perquisite value in this case. So there are two perquisite. One is 11,000 use, 66,000 permanent transfer. Entertainment allowance, we understand this is fully taxable allowance. Concessional loan facility is a working note. It was a time consuming process. So I have made the working note on the next page. Facility of laptop is exempt. So this is gross salary deduction under section 16, and this is the income under the head salary. But yes, this working note was a bit cumbersome. So I have calculated the interest also. This is simple mathematics, and we have already discussed this. So this was your MTP number for the series 1, and soon ICI will be releasing MTP series 2. That also we will be discussing. As soon as they will release, we will discuss that also. So I believe that you find this video very interesting. You find these lectures very interesting and also very helpful, because whenever you attempt these questions, and that too with the writing practice, it gives you immense confidence. I understand the course is so much. I do understand the course is so much. There are, in fact, for income tax, it's one of the vast subject for intermediate level, and you tend to forget so many things. But the best way to revise these things, the best way to retain this thing is to practice, and that to practice with the help of questions. And please tell me how you are finding these videos, right? Please write your feedback in the comment section so that I can able to understand what else you need and how you are finding these videos. So let's we will continue in our next lecture. Till then, bye bye and take care.